Hey, what is up, guys, and welcome back to the channel. So if you're new here, go ahead and hit the like button, hit the subscribe button, and let's get right into the video. So in this video, we're going to be going over why it would make sense to invest versus actually be invested in like an S&P 500 index fund. And what I mean by invest, I mean invest in stocks, invest in particular stocks. I mean, when would it make sense for a person to plan for their retirement and actually pick out those stocks, and when it would make sense to actually just invest in something more hands-free, like an S&P 500 index fund, and who would benefit from it. Okay, so basically, since the dawn of time, for the past like 50 years, everybody's been investing in what they call ETFs. Okay, now ETFs were basically created as a way for the average everyday person to go ahead, invest, get a return in the stock market at a certain percent, and return that every single year so that they could retire someday. I have news for you. Unless you plan on investing millions of dollars, your odds of actually being able to retire off of that are very unlikely. So I've come up with a couple other solutions, and I'm going to go ahead and break the math down on a 40-year investment at an 8.5% return versus a 40-year return. Now, we already went over the fact that monkeys actually beat the S&P 500 index fund by 1 I think it was 7% in a study by, I believe it was actually New York Times. So we went over that in the last video. If you didn't see that, go ahead and you could probably click up here to check it out. But monkeys actually ended up beating an S&P 500 index fund. And basically how it was done is monkeys stock picked, okay? And most of the stocks that they ended up picking were medium and smaller companies, and the money was distributed equally between the small, the medium, and the large companies in the study with the monkeys. However, in an S&P 500 index fund, it's all spread out, equally amongst the actual stocks itself based on the market cap. So if the market cap is bigger, more money goes into it. If the market cap is smaller, less money goes into it. Now, as I said, why would it make sense for someone to stock pick versus actually invest in something like an S&P 500 index fund? Well, when you're going ahead and you're learning investing, okay, when you're actually paying attention to the market every single day, when you're looking at stocks, analyzing future potential of stocks, in my opinion, it's a lot easier to be able to pick and decipher which companies you think are going to do well in the future based on their balance sheet, based on their PE ratio that they're currently sitting at, okay, based on the company itself and the future projections, okay, and based on the most recent earnings. When you are doing all of those things, checking out their balance sheet, making sure their company is in order, making sure that they're continually having good profits, you're sitting in on the quarterly meetings to understand the business and how the business is doing. The business isn't making bad PR mistakes. Obviously, that's not on you, but you got to understand, if a business keeps doing bad PR over and over and over, and what I mean by PR is anything that could really hurt the business that isn't necessarily detrimental to the business itself, okay? This is a lot of the trades that we'll end up making on this channel are because of PR, okay? However, when you're long-term investing, a company like Facebook, for instance, has repeatedly over and over had bad PR for the past year. I mean, it's literally the only company I can think of that no matter how good their company is, no matter how good their profits are, them consistently doing dumb stuff over and over and over and over again shines a really bad light on public relations and their actual investors themselves. Literally every single time we see some sort of push down in Facebook at this point, I just assume it's always because of PR. And public relations can really hurt a business. For instance, a company like Facebook, in my opinion, is probably worth several $100 billion more than it's sitting at. However, because of the fact that they do, I mean, they've had like 3 lawsuits within like the past 6 months that were a big deal. They were, I believe, they were getting investigated by the Supreme Court for going ahead and impeding information about the election. They've done a lot of stuff that is very, very questionable, and that has led to very bad earnings from the company. Now, when you're paying attention to, as I said, all of these things, I think you can do very, very well for yourself instead of investing in an S&P 500 index fund. However, if you are going to be one of those guys who says, hey, my buddy is investing in this, I'm going to invest in it as well, then you may want to just pick an S&P 500 index fund, because you're not doing the proper research to understand what it takes to build a successful business. And that's the thing. You have to understand what it takes to build a successful business, what a good balance sheet consists of, making sure that they have enough cash on hand to survive any crisis, outbreak, or pandemic that is on the verge. You have to make sure that their cash flows look good. You have to make sure that you're sitting at the quarterly meetings and you understand that they're trying to become more profitable. You have to literally account for all of these things if you are going to stock pick. And most people, if they actually do all the work that it takes and actually stock pick, will end up doing very, very well in the stock market compared to an S&P 500 index fund. For example, I'm going to go ahead and break down 2 charts here. One is a chart with a 20% per year return, which is nothing crazy in the stock market, but it is very good. And I'm going to also put a chart of the S&P 500 index fund right here. All right, so that's basically investing about $1,000 a month, and that's the return after about 20 years. Look, guys, the numbers are actually insane how different your life could be based on the scenarios and how well you do with the stock market. And I think at the end of the day, it all comes down to being consistent with it. And it's one of those things where if you spend a lot of time doing it, you are bound to get better and better and better. Now, I'm going to go ahead and pull back for a second. Let's talk about personal finance, okay? If you are a person that has had trouble keeping any type of money or any type of savings, you got to understand that when we're older, okay, we're like most of us, I'm assuming watching the video are probably either millennials or Generation Z, okay? Most of us might not get the opportunity to ever have any type of retirement within Social Security or anything like that. So you got to understand, we got to start like making actual income from our money that's invested or just sitting in the bank. And I'm going to break down why money sitting in the bank versus an S&P 500 index fund is a very poor decision, okay? Now, an S&P 500 index fund, since the dawn of time, has like returned about 8.5% return per year, okay? If you analyzed it with like inflation and you took all that out of there, it would still be around 7%, which is still fantastic. But I'm going to go ahead, put 2 charts up and show you the difference between your money sitting in a bank account and your money actually getting returned by an S&P 500 index fund now. As you can see the difference here. It's actually stunning how much money and how big the difference actually is. And this is what it brings me back to. If you're not going to take the time to stock pick, if you're not going to take the time to understand a company, how a company works, the balance sheets, everything like that, and you're not even going to understand trade, like you don't even need to know trading. All you need to know is the balance sheets, the PE ratios, that type of stuff, and you can do really well in the stock market. But if you don't want to understand any of that, just invest in an S&P 500 index fund, okay? And if you're one of those guys that is just like, you know, I just don't invest, I don't trust my money anywhere, guys, you got to understand, the bank, what they do with your money, they invest it, okay? That's what the bank is doing. Okay, so every day you have your money in the bank, Like that's what they're doing. And it doesn't mean that you shouldn't keep any money in the bank. Obviously, I always keep like 12 months or 24 months worth of money in the bank as well. But this is one thing you got to understand. The bank is investing your money right now. That's how they make their money. Okay, they're investing your money. And that's exactly what you should be doing. You shouldn't be investing your money. You shouldn't be giving your money away for free. Now, a lot of people aren't educated on this topic, and a lot of people think that, having $1 million in your bank account would be cool. It's not cool. Having $1 million in your bank account would be very stupid. If you're making 20% a year on $1 million, that's $200,000 a year you're making off of that money. And you're like, well, it's cooler in the bank account. Well, it's a lot cooler when it's $1.2 million at the end of the year instead of $1 million and $1,000 because you got a 0.01% return. So look, if you're looking to invest into your future and you're not looking to do any work, S&P 500 index fund may be the way for you. However, if you're looking to return a better return, if you're looking to actually do something, look, follow this channel, go ahead, subscribe, hit the button below. I'm going to be going into my picks that I'm actually going in depth in why I'm investing into each company. I'm going to go into the balance sheets, the PE ratios. I'm going to start breaking down companies and why they're good and why other companies are bad. And then we're going to go into some trading strategies as well, and what companies are sitting down, why we're investing in them, when they break through the EMA line, why we would buy, when they're consolidating, why we would start watching them. We're going to go into all that stuff in future videos, but guys, you got to understand the difference between investing now versus waiting and investing later. It's massive. Okay, when you're if you're a millennial right now, if you're Generation Z right now, you should be investing. Okay, you should be investing pretty much every dollar you make. And at the end of the day, when you're 25 years old, when you're 28 years old, no one's expecting you to have a lot of money. Okay, no one's expecting you to be completely have your entire life figured out at that point. No one's expecting you to do that. However, by the age of 40, by the age of 45, everyone is expecting you to have your life figured out. Everyone's expecting you not to be living in your mom's basement. Everyone is expecting you to have a decent income, to have investments to fall back on. Everyone is expecting you at that point to be financially secure. So it is your job in the next 5, 10, 15 years, however old you are, however long you have until you're 40, 45, 50, 55. It's your job now to start investing for that time in the future. It's your job as a person to be financially educated enough to go ahead, go out of your way and start figuring this stuff out, because this stuff is important. I hear it every single day, like, no, I'm not going to do that. No, I'll be dead by then. No, and guys, I'm telling you, let's say you're gone. Let's say you passed away by then. Did you not want to take care of your kids, your family? You know what I'm saying? So understand that it's not always just about you. This is about creating a legacy. This is about building wealth and generational wealth for your next couple generations. This is about actually creating and paving the way, not only for yourself but your family, for your retirement, for everything. And this is important. So anyways, guys, that's all I'm going to break down in this video. But if you want to go ahead and check out the link from the actual monkey study that was done, you can go ahead, click a link, probably down in the description. Actually, I'll just put it down there. It basically breaks down that the monkeys at random, while blindfolded, actually beat the S&P 500 index fund. It also kind of explains why, and I think I went into it as well a little bit. Basically, our PEs are sitting a lot lower in the small market cap stocks and the medium than the large market cap stocks. And the large market cap stocks, like a Coca-Cola or a Pepsi, they just grow a lot slower. Okay, so it's very slow, sustained growth. However, that's where you lose a lot of the growth as well. Okay, when you're investing like a company like an Amazon or a Tesla, obviously you're going to see larger gains, but you also have a slightly higher risk as well. And that's the difference between an S&P 500 index fund and actually picking your own stocks out. And a couple other people have gone into this video on why it's better to stock pick. But as I said before, if you're not going to take the time to learn anything, S&P 500 index fund or some type of index is fine. If you're going to take the time out, look guys, the difference between now and then in 40 years, it's going to be huge versus a stock, if you're actual stock picking versus an index fund. I'm actually just going to leave that right here one more time just to show you. And anyways, guys, that's pretty much it for this video. If you did go ahead and get some value out of this, please go ahead, hit the like button, hit the subscribe button. Until next time, see ya.